Okay, it's now 11:31, so we'll make a start. So moving on to the agenda page, please. Good morning and welcome to the latest in BDO's quarterly financial reporting updates. My name is Annie Taylor and I'll be joined today by my colleague Moses Surfety, and we work in BDO's technical financial reporting team. We expect today's webinar to last approximately 45 to 50 minutes, including time for Q&A. If you would like to ask a question, please could you use the Q&A function that you can access from the bottom of your screen. Time permitting, we'll aim to answer the questions during the webinar, but if we don't get time, then we will respond to you afterwards. So please, if you do absolutely want a response to your question, could you make sure that you don't ask your question anonymously, so we'll be able to contact you subsequently. So what's on the agenda for today? We're going to begin with an IFRS update, primarily including reminders for the upcoming interim reporting season. We'll also touch on the recent FRC thematic review on fair value measurement that was published very recently. We'll then move on to a brief UK GAAP update before considering developments in the sustainability space, and we'll conclude with some other regulatory and corporate reporting news. So I'm now going to hand over to Moses, who will start with the IFRS update.
Thanks, Annie. If we can have the next slide, please. So in this session, we'll cover changes to IFRS. Next slide, please. So what's new, what's effective for 30th of June 2023 interims? So you've got there on your screen three boxes: IFRS 17, IS 12, IS 1 and IS 8. We'll cover IFRS 17 in more detail, so I won't talk much about it now. IS 12, there's two amendments. The first one we've covered in previous webinars, which relates to deferred tax related to assets and liabilities arising from a single transaction. And what type of transaction is that? Well, that could be a lease or a decommissioning provision where you recognize an asset and liability at the same time. What's the amendment? Well, it says that you now need to account for deferred tax. In the past, there was mixed practice in accounting for these transactions. And in terms of what the key things to understand when implementing this change to IS 12 is, well, what is the tax treatment on these transactions? Are they taxed immediately, over time, differently from the accounting? And that will then drive whether or not you need to recognize deferred tax. And it's probably worth pointing out that, say, taking the example of leases, they may be taxed differently in different jurisdictions. So again, you'll have to familiarize yourself with the tax legislation in the jurisdictions you operate before concluding whether or not this change has an impact. The next one is rather narrower in scope. It's Pillar 2 model rules, only applies to large entities that operate in low tax jurisdictions. And what's the change? The change is that there's an exemption from applying deferred tax to these Pillar 2 taxes. And why has the ISSB made this amendment? Well, just because there was a fair degree of confusion as to, due to the complexity of the rules, it may not be easy to compute deferred tax. So we have an exemption for that. Worth pointing out that this second amendment has not yet been endorsed by UKEB, which is the UK Endorsement Board, but they've put their draft endorsement criteria out. It's actually a shortened comment period. It's the 10th of July if you want to get a comment in as to whether you agree or disagree with UKEB's proposal to adopt, which is what they're proposing to do. And the reason there's a shortened comment period is because we're expecting this to come into UK legislation, so it could potentially affect UK entities reporting for their 30th June reporting. So the UKEB are expecting to, once the comment period ends, to hopefully endorse pretty soon after that in July. So that's tax. Then moving on to IS1 and IS8. Again, this is not something that we would expect too much impact in interims, because not too many people talk about accounting, their accounting policies in interims. You normally you only need to have a statement of whether you've applied the same ones as you did in your full year accounts. But these amendments are there to improve accounting policy disclosures and to focus on material accounting policies. So again, this is something more preparation for next year's accounts. So if we move on to the next slide, where we're going to look at IFRS 17 insurance contracts. A key message to take away is that IFRS 17 is not necessarily a standard for insurers. It is a standard for insurance contracts. So you might say, I'm not an insurer, I don't issue insurance contracts, therefore I'm out of scope. Well, that may or may not be true. And why is it important now? Well, it's important now because IFRS 17 replaces IFRS 4, which was an as you were standard, i.e. it said you just have to, you're allowed to carry on doing what you've been doing before IFRS 4 came in, when it came to insurance contracts. Whereas now, if you are in scope of IFRS 17, you will have to apply insurance contract accounting, which potentially is quite complex. So helpfully, after all that, there are exceptions and exemptions in the standard. So it is going to be quite important that you, as it says here on the slide, identify whether or not you are issuing a contract that meets the definition of an insurance contract, assess whether you're within the scope exemptions, and then analyze the accounting implications of that. So before you, like I said, the key message is that before you didn't have to know if you met the definition, because you were able to do what you were doing before, whereas now you need to at least assess whether you identify whether your contracts meet the definition. So if we move on to the next slide. So here we've got the definition of an insurance contract. It's a contract where the issuer accepts insurance risk from another party to compensate the policyholder if a specified insurer event adversely affects the policyholder. So firstly, well, what is insurance risk? It's risk other than financial risk transferred from the holder of a contract to the issuer. So what this is doing, this is scoping out financial risk, and you've got there on the right-hand box the definition of insurance risk, sorry, of financial risk. So if you've got a contract where the amount that one pays depends on specified interest rate or financial instrument price, that would not meet the definition of an insurance contract, and most likely meet the definition of a financial instrument, and you'd probably be caught by IFRS 9 and IS 32. So what could be an insurance contract? Now, clearly, we all know what an insurance contract looks like. You've got, house insurance, and if we move on to the next slide, you've on the next slide, we've got examples here of what would meet the definition of insurance contract. So a list there. I'm not going to tutor you in those, but just want to draw attention to on the right hand side, the middle one, product warranties issued by another party for goods sold by manufacturer, dealer, or retailer. We're going to cover that in more detail. So if we move on to the next slide, we've got here a list of some scope exemptions. As you will see, there's quite a few of them. I'm only proposing to talk in detail about the top ones in each column. So product warranties and fixed fee contracts. But while we're on this slide, just point out certain financial guarantee contracts may be in scope, are potentially in scope of IFRS 17. Where might you see a financial guarantee where you've got cross guarantees between parents and subsidiaries, guaranteeing borrowings of one another? Those would meet the definition of an insurance contract. There's a policy choice there. You can either account for them under the financial instrument standards or under IFRS 17. Again, typically we we see people accounting, or we're expecting to see people accounting for these under the financial instrument standards, which normally, again, for like something like a cross guarantee, you'd be doing a credit risk assessment of the counterparty. The other one clearly is, if you're the policy holder, then you're out of scope. Nobody accounts for, their buildings insurance as an insurance contract. You just prepay spread the cost over the insured period. And yeah, so those are some typical ones. Now we're going to go into a bit more detail on the next slide. So we've got here an example of a product warranties, and the scope. There's a scope exemption. Now, when is a warranty outside the scope of IFRS 17? So there's two conditions. They need to be provided by manufacturer, dealer, or retailer. And the second requirement is that they're in connection with the sale of its products to a customer. And so how does one account for those? They are typically accounted for within IFRS 15 and IS 37. And you would just carry on your normal accounting for that. But when I just want to illustrate the point that there may be some complexity in applying this exemption, particularly when you have different entities, say within a group, that are providing those warranties. So in this example here, we've got the parent, which is the manufacturer dealer, let's say the car dealer, and the parent provides a standard 12-month warranty on the cars that it sells. But the customer is also given the option of buying an extended warranty, let's say a 3-year warranty, which the customer can choose to take up or not. That same subsidiary also applies an after-sale extended warranty. So let's say when that 3-year extended warranty runs out, or if somebody's just taken the standard 12-month warranty, that they're able to approach the subsidiary company to buy, or the customer is able to approach the subsidiary in order to buy a warranty. So let's explore the accounting. So the standard 12-month warranty, the parent's issuing it, it's issuing at the time of the sale. So then the exclusion applies, and that does not need to be accounted for under IFRS 17. Then you've got the extended warranty that is issued by the subsidiary at the time of the sale. So in the group accounts of this group, which incorporates the parents and the subsidiary, that warranty does not need to be accounted for under IFRS 17, and is accounted for under IFRS 15 and 37. However, in the accounts of the subsidiary company, because the subsidiary is not a manufacturer, dealer, or retailer, it cannot take the scope exemption, so it would have to account for the extended warranty under IFRS 17 in its accounts. Then looking at the after-sale extended warranty, this is a standalone warranty. From a group accounts point of view, it may be issued by a manufacturer, retailer, or dealer, but because it is not issued in connection with the sale of a product, it is in the scope of IFRS 17, and the scope exclusion does not apply. So in both the parent, in both the group accounts and the subsidiaries accounts, this after-sale extended warranty would need to be accounted for under IFRS 17. So again, that's something that's worth thinking about if you've got separate entities issuing warranties, that they may be caught by IFRS 17. So moving on to the next slide. This is an optional scope exemption. So the previous one was a mandatory exemption. Fixed fee contracts. And where might we see fixed fee contracts? So there you've got maintenance contracts, i.e. repair plan. Again, I'm thinking of cars again. or also roadside assistance, your contract with the AA or RAC or Green Flag. Other providers are available. So what's the choices here? As I said, it's an optional exemption. You may choose to apply IFRS 15 or IFRS 17. But when can you choose to apply, say, IFRS 17? Well, there's three conditions or three criteria. The first one is that the price charged is not based on an assessment of risks relating to individual customers. And typically you tend to see that, say, in roadside assistance, where, the AA or the RC or Green Flag will offer you a fixed will offer you cover for your car without asking you necessarily, say, about your claims history or the condition of your car. The second criterion is that the contract compensation is in the form of services, not cash. So if you have like a cashback policy every time your car breaks down, that would fail. The definition that would not meet the scope exemption criteria. And the third criterion is that the insurance risk arises primarily from the customer's use of the service rather than the cost of the service. And again, you would tend to see this in stuff like your roadside assistance. Probably also worth pointing out, as it says on the top box there, that this exemption is available on a contract by contract basis. Personally, I find it odd. Why would you want to not do it on a class of contract basis? But that's the way the standard is written. So there is leeway for anybody who fancies doing IFRS 7 insurance accounting for some of their contracts. So that's it on IFRS 17. We're now going to move on to the next slide and talk about supplier finance arrangements. So the ISSB in May issued an amendment to IS 7 IFRS 7, and this basically came from the fallout from Carillion, where there was a lot of debate, some of it quite heated, about accounting and presentation for supplier finance arrangements, where suppliers are being paid by a third party, typically a bank, and then, as you see in the diagram on the slide, the purchaser pays the bank at a later date. And it's interesting where we've ended up. We've ended up in a standard which tells us to give better disclosures, which is interesting considering the debate started as an accounting or presentation issue. So what do you need to disclose? Well, there's quite a few disclosures, the terms and conditions of these arrangements. So you need to disclose how extensive these are and what criteria a supplier might need to meet in order to be able to access this finance. You then also need to disclose the amount of liabilities that are part of the arrangements, splitting that out into where the supplier has already received payment from the finance provider, and then giving and where they haven't, and you've got to give the availability as well, and then disclosing where the liabilities sit on the balance sheet. Again, typically people will have kept these balances within trade creditors. There's no requirement to change that, although clearly for your record keeping, that might be something that you would want to consider as to whether you present a separate line going forwards, just to make the disclosure easier. You also then need to give the ranges of payment due dates and liquidity risk information, i.e. when you would expect to be paying, when the entity would be expecting to or the purchaser to make the payments to the bank. These amendments are effective for annual reporting periods beginning on or after 1st of January 2024. So and we're expecting this to be endorsed over the next 6-7 months. And the key message here is about getting ready and ensuring you know what you need to disclose. And if you don't have that information to hand yet, then making arrangements to request that typically I would think the bank would be the place to start when getting the information ready. So we're now going to move on to the next slide, and this isn't actually the next few slides are actually not changes in accounting, but we thought we'd put them in here because the FRC have produced a thematic review on IFRS 13 fair value measurement. Why have they done that? Well, we are living in a period of uncertainty where we are seeing interest rates rises, inflation changing. So the economy is quite different, say, to what it might have been 2 or 3 years ago, and I think the FRC believe that preparers sometimes just roll forward disclosures, and I think this is a bit of a reminder that you might need to rethink your disclosures, particularly in connection with fair values, because like I said, discount rates are changing, in inflation is changing. We are also living in a climate emergency where government policy is changing, investor expectations are changing. So all of those things are contributing to increased uncertainty and changes, say, to previous practices. So and just as a bit of background, this was a slightly different thematic in that the FRC didn't pick, say, a range of companies and look at their disclosures. They just collated information that they've had from previous reviews from other departments, and in the FRC, I'm thinking perhaps the audit quality review team, who will see in detail on audit files what companies do and don't prepare when they're doing IFRS 13 disclosures. Again, just as a reminder in terms of, well, what is fair value? Fair value is the price one would obtain in an ordinary transaction to sell an asset or transfer liability between market participants. And the thematic gives a few examples of areas where they've challenged, and it's worth reading those, because some of those are perhaps not untypical transactions that companies may enter into. So one was where they challenged loans and guarantees given by a company to a joint venture, where they challenged the initial fair value measurement or the absence of any measurement in the case of guarantees, and the company went and restated its financial statements. They also gave a few reminders, say, on fair valuing equity instruments, pointing to the standards and educational material. Again, those are perhaps useful reminders given the state of the economy at the moment. So if we move on to the next slide. So what did they find? Again, they're all there on the slide. You know, fair value measurements should use market participants' assumptions and not entity-specific assumptions. So, you know, just because you lent at 2% doesn't mean that the market would lend at 2%. So you've got to think about that. And that the next point on that box follows. You know, that therefore the transaction price will not reflect fair value. One other thing they saw, and I suspect this probably came from the audit quality review team, you know, consider the need for specialist third-party advice. Some fair values may be easy, others are not, and if it's either complex or material, or there isn't the expertise in the company to do the calculation, the FRC are urging companies to take third-party advice. And the last one, which is probably the key driver of this whole thematic, is about the quality of the disclosures. Where did they, with the FRC, find issues? Well, they found issues in disclosure of recurring level 3 measurements. Just as a reminder, IFRS 13 has a hierarchy of fair value measurements. Level 1 is where you've got unadjusted quoted prices. Level 2 is where you've got observable inputs, and level 3 is where you've got unobservable inputs. And in terms of typical examples, what's a level 1 instrument? A share that's quoted on the London Stock Exchange, that would be a level 1 measurement. A level 2 measurement typically you would tend to see for, say, swaps, where you might have reference interest rates or interest rate swaps. So you will have a reference interest rates which you would use to benchmark a value. And level 3 is where you've got unobservable inputs. Again, typically one sees those in, say, valuations of investment property, but you would also see them sometimes in terms of in financial instruments, where you've got like a contingent consideration arrangement under a business combination. And I mean, I'm just going to go now through some of the other examples they challenge. Again, they challenge the disclosures on highest and best use. You know, for non-financial assets, you're meant to give state whether the valuation reflects the highest and best use or not. They've also challenged use of depreciated replacement costs for fixed assets, i.e. challenged the quality of the disclosures because they couldn't see how, say, the construction cost was determined, or how obsolescence of the assets had been given. They also discuss credit risk and own credit risk. Again, those are typically inputs that you use in looking at the quality of the counterparty to an instrument, or own credit risk is your own credit quality. Climate-related matters, again, this is something that I hoped Annie would be the only person talking about, but investors want to know how climate-related matters have affected fair value measurement, how they've been incorporated, say, into the valuation model. It's not sufficient to say they have been incorporated into the model. Now, that might mean that, you know, as a preparer, you need to think a bit more about the use of your accounts and what they are expecting. Some of that you might do by communication with investors. Some of it might involve a bit of guesswork, or looking to see what peer companies are doing. Another area where the FRC did challenge categorizations is something at level 2, i.e. Observably, an input that's observable, or is something level 3. And why do they challenge it? Well, because the disclosures for level 2 are lighter than for level 3. So preparers tend to have a tendency to seek to say that the fair value measurement category is level 2 instead of level 3. So again, something to watch out for and think about, particularly in the current economic climate. So if we move on to the next slide, where again this is a replica of page 25 of the thematic, and if you don't have time to read the whole thing, it's only 27 pages. I would suggest you look at this and the following page, where there's a good summary of the requirements of the standard. And the expectations are basically a reflection of their findings. So I'm not going to go into this in much more detail. So if we now move on to UK GAAP on the next slide. So the good thing about this is there's not much changing under UK GAAP. I'll start with the box on the right. First, the annual review of IFRS 101. Again, just a reminder, IFRS 101 is like an IFRS Lite, which can be used by UK companies. Officially, it is still called UK accounting standards and no international accounting standards, and the FRC periodically review it for changes in IFRS that need to be incorporated into IFRS 101. The conclusion is that there's no change, so that's good. On the left-hand side, we've got FRED 83, which replicates broadly replicates the requirements in the amendment to IAS 12 that we discussed earlier. Again, not expected to have a significant impact on a lot of UK companies, but it's there and I suspect we should be expecting an amendment to IFRS 102 to come out pretty shortly. So that's it from UK GAAP and IFRS news, and now I'll hand over to Annie.
Thank you very much, Moses. So we're going to start with a sustainability update now. So moving on. Okay, so starting off with the EU. So this is just a quick update in respect of European sustainability reporting standards. So as a reminder, there's a proposed new piece of legislation that will affect EU entities called the Corporate Reporting and Sustainability Directive. And this is going to revise and expand the current requirements of the existing non-financial reporting directive. Essentially, there's two things to think about here. That when this legislation comes into effect, it will widen the scope of entities that are captured by the scope of the financial reporting requirements that the legislation mandates. Also, it includes sustainability reporting requirements. That means that entities within scope will need to comply with what we call ESRSs, the European Sustainability Reporting Standards. So in our December webinar, we advised that the first batch of these ESRSs had been delivered to the European Commission, and these were expected to be adopted by the end of June. Now, what's happened since is that the European Commission has received feedback from various stakeholders, and as a result, there's been numerous modifications to what that first batch looked like when it was delivered to the European Commission back in November. This is primarily in respect of increasing the number of disclosures that are subject to a materiality assessment, introducing more flexibility, making some disclosures that were previously mandatory voluntary, and including some transitional requirements. So in general, it is good news. So you may ask, why am I telling you this? This is a specific EU matter. The thing to be careful here about is that the scope of the CSRD and as a result these ESRSs is pretty wide. Now, it includes your EU listed entities, it includes large EU entities, so those that meet 2 out of 3 of certain criteria, being over 40 million turnover, over 250 employees, and over 20 million total assets. But one important thing to note is that the scope does actually expand to capture non-EU groups. So if your company group happens to generate over 150 million euros turnover and has a subsidiary or a branch that meets the large entity criteria, then you would actually be within scope. And it's important just to be aware of this because these standards are quite extensive and quite comprehensive and require a lot of data to be collected in order to comply with them. So probably if this has triggered the thought in your head that, oh, perhaps this might be relevant to me, then I would direct you again to look at the BDO Global sustainability reporting updates, the links to which are provided on screen, and you'll receive the slide pack after the webinar. Now, in terms of when these standards apply, there is a phased, they're going to be phased in basically. So those entities that will need to comply with them soon, i.e. in 2024, will be those entities that are currently within the scope of the existing non-financial reporting directive. So that would be large public interest entities, so entities listed on an EU regulated exchange, or banks and insurance companies that have more than 500 employees. Then subsequently the scope of the requirements will be phased in for other entities that are in scope, with those non-EU undertakings captured in 2028. So it might seem quite far ahead in the future, but it's always best to be prepared, particularly because of the complexity of collating this information in advance. Moving on to the next slide. In terms of ISSB activity, well, the headline item on this slide is obviously IFRS S1 and IFRS S2. So the ISSB's first standards that require the disclosure of sustainability-related financial information and climate-related disclosures have now been issued. Hot off the press, they were issued yesterday. So we intend to cover this comprehensively in our September webinar. In the meantime, BDO Global has produced a sustainability reporting bulletin. And what we intend to do is, after today's webinar, in the follow-up email you'll receive, you will also receive links to that publication. So that provides a very useful and comprehensive summary of what's ultimately ended up in these two standards. So in broad terms, they will be effective from 1st of January 2024. However, obviously this will depend on your jurisdiction. The standards will need to be adopted by a particular jurisdiction. And as a result, the effective date could be later. So that's probably a case of watch this space. One thing the ISSB has announced is that they'll be including transitional reliefs in terms of it is only from year 2 of disclosing in accordance with these standards that entities will need to disclose all sustainability related risks and opportunities. From year 1, they will just need to disclose climate related risks and opportunities. Other ISSB work and news includes 2 consultations that are currently ongoing. So firstly, the ISSB is looking to receive feedback on what stakeholders consider should be the types of projects they should enter into over the next 2 years and what they should prioritise. That first consultation is open until the 1st of September. The second consultation is with regard to the proposed methodology for enhancing the international applicability of the ISSB standards. One thing that they've noted is that their objective is for the ISSB metrics to be revised prior to IFRS S1 coming into effect in January 2024. That consultation closes a little bit earlier on the 9th of August 2023. Moving on to the next slide, please. We're just going to touch briefly on some regulatory news. Now, there is an FCA consultation currently ongoing, which closes on the 28th of June 2023, which is, as I'm sure you know, tomorrow. So if you would like to have your views heard in respect of this consultation, you need to get moving. Essentially, this FCA consultation has resulted from research that they've undertaken and reviews that they've undertaken, which has identified that certain companies who might be considering a listing in the UK are deterred by the complexities of the requirements that entail having a listing on the main market of the London Stock Exchange. So the purpose of the consultation is to determine how the competitiveness of the UK equity market can be improved and how it can be made a more attractive and compelling option for those companies that are looking to seek a listing or considering a listing in the UK. The main proposal would be for the current standard and premium listing share categories for commercial companies to be rationalised and replaced with a single category for all commercial companies. It's proposed that the sponsor regime will be retained and also discrete listing categories will be retained for other types of instruments. So in respect of, for example, close-ended investment funds. So as I said, in terms of next steps, the consultation closes tomorrow. There is intended to be a further consultation on wider proposed changes to the listing regime in autumn of this year. So we'll update you on that as and when we find out more. Moving on to other corporate reporting news. And the next slide, please. So we wanted to give you a brief update on the BEIS consultation response. So as a bit of background, in our June webinar, we provided details of the extensive proposals that the government had outlined in their response to their previous consultation on restoring trust in audit and corporate reporting. Now, you'll note that we're referring to this no longer as the BEIS consultation, but the DBP consultation. So the DBT. DBT stands for the Department of Business and Trade, and that is where responsibility for audit and corporate governance will now sit. Now, in that consultation response, we outlined a broad and deep number of different measures. And we're going to focus today on the 4 new financial reporting requirements. This is because although the draft regulations that will bring these requirements into UK law for certain entities are expected to be published soon. So we just wanted to give a bit of an overview as to what they will include, who will be in scope, and when we anticipate them to be effective from. So the 4 new reporting requirements are shown on screen, starting with a resilience statement, which will be an annual statement setting out how a company is managing risks over the short, medium and long term. There will then be a new requirement introduced for a triennial audit and assurance policy, which will explain how the company proposes to assure non-financial reporting over the following 3 years. In the intermittent periods when the policy isn't required to be included, disclosure will be required in respect of how the company has complied with that policy in that period, or any updates to that policy, etc. There will also be capital maintenance disclosures introduced, which will include an annual statement about distributable profits, the company's details of the company's policy on distributions, and a distribution statement. And finally, there will be introduced a requirement for a material fraud statement, which will entail an annual statement on steps taken to prevent and detect material fraud. Moving on to the next slide. Who will be in scope of these new requirements? Well, the anticipated scope is what is termed as a company with a high level of employees and turnover. This will include public and private entities which have more than 750 employees and greater than or equal than £750 million turnover. So in terms of banks and insurers, we believe that the government is currently considering what the equivalent will be in terms of turnover, because these types of entities don't traditionally generate turnover in the what is commonly understood by that term. Parent companies will need to look at the aggregate numbers for their group, regardless of location. So if they've got entities in their group that are domiciled overseas, they will still be captured when determining whether these criteria will be met. And the number of employees, you'll need to look at the employees that are employed each month via a contract of service divided by 12, regardless of whether the employee is continuously employed throughout each month. In terms of expected timing, now, just as a caveat, these regulations haven't been finalised yet. This is anticipated timing rather than a known fact. What we expect is that companies that are already listed on the main market will be required to meet these financial reporting requirements from 1st of January 2025. We expect that other public and private companies will have a bit more time to comply, and that they'll likely be required to comply by 1st of January 2026. The reason for this staggered approach is that those companies which already have listing on the main market are already subject to more complex and detailed reporting requirements. So we'll find it less onerous in order to meet these new mandatory requirements by law. Moving on. So this slide just identifies where we expect these disclosures to be provided. So the resilience statement, we expect that to be a strategic report. requirement, the audit and assurance policy within the director's report, the capital maintenance disclosure and material fraud statement will be required to be disclosed across the director's reports and notes to the accounts. One thing to note in respect of the resilience statement and the audit and assurance policy is that currently there's a consultation ongoing from the FRC. They've released a draft corporate governance code, and in that corporate governance code, it does include certain provisions that will mean that companies that are within the scope of the code, but not within the scope of the new requirements, will have to provide similar but proportionate disclosures in these areas on a comply or explain basis. I'll explain that a bit further when I come to discuss the consultation on the corporate governance code, proposed changes to that corporate governance code. Next slide. So what else has been going on in respect of implementation of that government consultation response statement? Now, in its consultation response, the government outlined that the Audit, Reporting and Governance Authority will be given statutory powers to mandate minimum standards for audit committees in their role on the external audit. We gave an update in the December webinar that the FRC was consulting on what would be included in that minimum standard, and the final minimum standard has now been published. It will be applicable to companies with a premium listing on the London Stock Exchange that are included on the FTSE 350 index, but companies that are working towards obtaining a FTSE 350 index may find it helpful to provide the disclosures voluntarily. It should be read in conjunction with the FRC's Corporate Governance Code and their guidance on audit committees. It's currently voluntary for in-scope companies. However, once ARGA is set up, it will become mandatory. Moving on to the revisions to the Corporate Governance Code. Sorry, just back on the previous slide. So the proposed changes to the code focus on 5 areas, primarily on aligning the code with those changing legal requirements that I've spoken about previously, including the resilience statement and the audit and assurance policy. This consultation closes mid-September, on the 13th of September, so there's still time to feedback any views you may have. So moving on. So I said that the consultation proposes revisions to the code, and these broadly focus on 5 areas. So the first being that the parts of the code that deal with the need for a framework of prudent and effective controls will be revised to be more robust and require more comprehensive disclosure in this area. There will also be revisions to require the board to require the disclosure of a reflection of what the board and audit committee's responsibilities are for sustainability and ESG reporting. Amendments will be made to take account of the new audit committee standard. So in the previous slide, I referred to the fact that there was the final audit committee standard had been published. So in certain respects, in the FRC's Corporate Governance Code, there's some duplication of what is included in that audit committee standard. So what they propose to do is to include a cross-reference back to the standard rather than duplicating that information. Now, as you know, that audit committee standard will become mandatory for FTSE 350 companies. However, the FRC Corporate Governance Code has a slightly different scope that applies to UK incorporated entities with a premium listing on the main market of the London Stock Exchange. So as a result, those entities which aren't in scope of the audit committee standard but are in the scope of the code will to some extent need to consider the requirements of that standard and report against them on a comply or explain basis. Another thing the FRC is proposing in this consultation is to improve the functioning of comply or explain reporting. Now, this is something that came up in the recent FRC review of corporate governance, and in my own experience, it's when it comes to review the disclosures against the corporate governance code. In my experience, it's much more informative and gives me much more of an insight into the company's corporate governance procedures and how they've been applied in the current year. If the company states that they've departed from, say, one of the provisions of the codes, and then gives a coherent and tailored explanation as to why, rather than simply stating in a boilerplate disclosure that they've merely complied with everything. And this is where this proposed revision to the code comes from, and the fact that that is the information that investors want to see when they come to reviewing this disclosure. So ultimately, the purpose of this part of the consultation is to improve reporting in that area. Then finally, parts of the code, certain provisions in the code will be updated to ensure alignment with changes to legal and reporting requirements. So what do I mean by this? So the key changes are in respect of the resilience statement and the audit and assurance policy. So as a reminder, we're currently awaiting the draft legislation that will bring into law a requirement for entities which have over 750 employees and over 750 million turnover to include in their annual report an annual resilience statement and a triennial audit and assurance policy. So what the FRC is proposing to do is, in the corporate governance code, there is an existing provision 31 which relates to viability, which requires those companies within scope to prepare a viability statement. So the FRC proposes to revise that provision so that as a result, if a company has complied with the legal resilience statement requirement, they will also have complied with the revised provision of the code. Now, that will have a knock-on effect to other entities which aren't within the scope of these legal requirements, but are within the scope of the corporate governance code. But of course, then they will be able to report in respect of the code on a comply or explain basis. So it's expected to improve the level of disclosure, but still retaining the proportionality, because those entities will only have to report on a comply or explain basis. Similarly, for that audit and assurance policy, the proposal is to include a provision in the code that will require all code companies to prepare that audit and assurance policy. So again, bringing in certain companies that won't be captured by that legal requirement, but it will be proportionate because it will be on a comply or explain basis. Next slide, please. So the final piece of other corporate reporting news we wanted to touch on today was a review that's currently ongoing with regards to non-financial reporting requirements. This is a joint review that will be conducted by the newly formed Department of Business and Trade, and the FRC will also have input. So where this review has come from is it's notable that in recent years, there's been an increase in size and the complexity of annual reports. There's a myriad of different requirements that different companies need to meet, and the scope of each of these requirements can be different. When I talk about requirements, I'm talking about non-financial reporting requirements that come from company law, but as well from other sources, that, for example, those legal requirements that result in the requirement to produce a modern slavery statement or gender information on gender pay gap reporting. So when I come to review a set of financial statements, even within the strategic report, there's a number of different requirements that affect different type of entities. So small companies don't even need to produce a strategic report. Then we've got certain specific requirements that are only applicable to quoted entities, the Section 172 statement that is mandatory for large companies, and then the newly named non-financial and sustainability reporting, which is then if applicable to economically significant entities. So it can get quite confusing as to what different companies need to include. And also, the amount included in an annual report can get quite bulky and cumbersome and cluttered. So the overall objective of this consultation is to consider how this can be rationalised so that as a result, there is a benefit to the cost of producing this information, and investors are getting the information for a specific company that they need. So in terms of the scope of the review, it is broad. It will include the thresholds and definitions used to determine whether companies and LLPs must comply with certain requirements. It will also cover the future of the UK's non-financial reporting framework, including considerations about how to integrate ISSB standards into the UK's reporting framework. That consultation is open until 16th of August 2023. So if interested, do have a look at that and have your say. So that brings us to the end of the slides we wanted to cover today. Now, I do note we do have one question on IFRS 17 that I don't know whether, Moses, do you want to answer that in today's session?
Yeah, thanks, Annie. I will. So the question is, would a 15-year manufacturer warranty be classed as an insurance contract? And I suppose the question, the answer, I was wondering why this question being asked. I assume it's because it's the ultimate customer, so let's say not the retailer, who gets the benefit of that of that warranty. And my instinct would be to say, well, if it meets the criteria, the two criteria that we mentioned earlier, then typically I would say yes, it ought to. And then I just wanted to add one more thing, because when I was discussing the example of the parent and the subsidiary, where the subsidiary issues the warranty, I meant to add that whilst the warranty would not meet the product warranty exclusion, it still is worth checking whether a warranty issued after the sale might still meet the fixed fee exclusion, which is an optional exclusion or exemption rather than a mandatory one. But you might fail on the product warranty because you're not the vendor, but you might still be able to get into the fixed fee exemption. So that I thought I'd add that, because I meant to say it and I forgot. So that's it. We've got no more questions. So I'll hand over to Annie to close off the session.
Thank you, Moses. So yeah, we don't have any more open questions. So thank you very much for attending today's webinar. We hope it's been useful and informative. You will receive a follow-up email, including the slide pack and that sustainability reporting bulletin link that I referred to previously. So otherwise, thank you very much for your attendance. And yeah, sorry, I've just seen another question. A link to the recording will be also provided subsequently. So thank you very much. And we will see you in September, where we will provide a more comprehensive update on those sustainability standards. Thank you very much, everyone, and goodbye.